What up, folks? It's your boy Kenneth, 100 Years of Wealth, StreamHomeLoan.com, back. Haven't made a video in a couple weeks. I've had a couple of things going on outside the office, but I'm back and I want to drop off some information that I think will be helpful to you and hopefully bring some value to what you're trying to do and what you're trying to accomplish. But I'm gonna make it quick, like I always say, and it ends up being a lot longer. But a question I've been getting a lot is, are we gonna see a real estate market crash? Are we gonna experience what we experienced in 2008 with the market, where there was tons of foreclosures, values dropped, etc.? Is that gonna happen? Okay. Obviously, I am not a psychic. I don't have a crystal ball, but I do have a perspective that is based on experience and knowledge of what actually happened in 2007 and 2008, because I was in the actual mortgage industry. Obviously, I'm still in the mortgage industry now, but I was in the industry at this time, and I was in the industry leading up to that time, all the way from like 2003. So I saw, or I think I started actually in 2000. No, I think it was 2003. But I saw this market and what happened leading up to it that created a potential for the foreclosure and the fallout and just the crash of the market that led to a bigger recession in our country and globally. And from the front end experience of being an actual loan officer at this time, what I know that created an issue was the type of lending that was going on at the time, right? In 2000, when I came into the industry in 2003, I was working for a company called Ditech.com, one of the bigger direct lenders at that time. They were part of GMAC, which was a huge lender at that time. They pretty much, I'm pretty sure that they're completely gone. But at that time, they were massive. They were doing tons of business throughout the country. As a direct lender or as a loan officer working for Ditech, we were doing tons of transactions on a monthly basis. Like on a low end, a loan officer by themselves would be doing like 50 or maybe 40 transaction. On a high end, 100 plus closed refinance transactions. All those transactions that they were doing, at least in the environment that we were in, or in the team that I was in, and I guess, how do I say, basically the unit within the company that I was in, we were only doing A paper loans. And I think that was a majority of the whole company, just focus on A paper lending, things that worked with conventional or conforming financing. That's it. Automated approvals, sending out disclosures every single day to 10 different clients throughout the country. It was very high paced, but it was all A paper and it was all fixed 30-year mortgages. Sometimes you do a shorter term loan, but my point being, it was very secure financing and very well qualified financing. These people had W-2s, pay stubs, or full tax returns that can provide proof of income. What I started to notice was, as the years in that refinance boom went on and I migrated to a different company, different companies were doing total different types of loans that were much riskier, right? So there was a whole industry of what was called subprime lending, where you could have a credit score as low as 500 and get some sort of a mortgage. And a lot of times you could have a pretty low score and not have to document your income. So you start layering these risks, where you have someone that has a low credit score. You're giving that person an adjustable rate mortgage, meaning that after 2 years, they're gonna have to refinance again because their rate's gonna start to adjust with the market. And then in certain scenarios, you're doing loans where someone's not being required to provide any sort of income. So you have people doing no income verification loans, meaning that they literally, if they had a credit score that can fit into the guidelines, they could literally not provide any income information at all. Or there were loans like stated income loans, where you can state your income. You can say, I make $10,000. When maybe you didn't make that money. Maybe a portion of that $10,000 that you were stating was because you're receiving room rent income, or you know what I mean, like a whole bunch of different factors could have led to someone stating their income, but a lot of times it was people just stating their income at a certain number to qualify for the loan, and because their credit score fit, it was workable. It wasn't a problem. And for a loan officer that was actually in an industry at the time, I was young. I was like 23 years old. I didn't have the foresight to look to the future and say, okay, well, this person does qualify for the loan, but maybe in the future they might not have the income or something like that. It was just, as a new loan officer, you're looking at the guidelines, you're saying, does this work or not? And if it does, you're gonna submit the loan and pass it on to underwriting to make the final decision. And that's what we were directed to do. So I think that looking back at that, I can look and say, yeah, I'm sure a lot of those people probably, weren't the right fit for a loan that didn't require income documentation. Those loans, to me, in my mind, in my mature state right now, those loans are geared towards people, or they should be geared towards people with high credit, proof of repaying their bills on time, assets in the bank so that they have, ample months of their mortgage payment in the bank. And then also, usually I would say it's best for someone that's self-employed, because it makes sense that a self-employed person might not show all of their income on their tax returns because of write-offs and expenses related to their business. So, what happened was you had a ton of loans in 2007. I think the number was like $10 million, 10 million loans that were set to adjust in 2007. You can correct me if I'm wrong, but that were set to adjust. And at the time that they were set to adjust, rates, or not really rates, but property values have started to dip because you're starting to have an increase in foreclosures. So when those people, a lot of them went to go and try to refinance, either their credit scores didn't get better to put them in a better pricing bracket, or property value had dipped, or they didn't have a positive track record on their mortgage history, allowing them to refinance into a better situation. That doesn't cover all of it, but there was factors that at the time that it was time to refinance into a better situation, those people weren't able to. So it rolled into an adjustable rate mortgage, rates started to increase, property values started to decrease, making it to where it was almost impossible for these people to refinance into something that would be better or equivalent to what they currently had. That started the snowball of the foreclosure market. And at the same time, you had other sub-industries sprouting up within the mortgage industry, like the loan modification industry. So you had a bunch of loan officers that were no longer loan officers that switched over to being loan modification officers. And what they were telling people was that, hey, look, we know that you're an adjustable rate. We know that your property value is probably upside down at this time. I don't want to say that this is exactly what they said, but the sentiment was that, hey, this is the lender's fault. They shouldn't have given you this type of loan. Hold off on making your payments, and we're going to negotiate with your lender some sort of modification to your loan. The reason why they would tell them to hold off on their payments was because a lender wasn't going to modify a loan if the person was on time with their payments and showing proof that they can actually repay their loan. So it was like creating these other factors where now you have people intentionally holding off on making their payments because you had such a massive loan modification market going on, where if it wasn't comfortable for you to make your mortgage payment, you were halting on making that payment and then putting the pressure on your lender to maybe defer some of the balance or defer some of the payments that you've missed. So that is my thoughts on why we had a big foreclosure market. And also part of it was that these securities or these loans are getting packaged up and sold as mortgage-backed securities. And you could, I think that movie, The Big Short, kind of explains it pretty well. But it was basically like these assets, once they started to have problems with repayment, right? Like, so you package up 1 million, home loans for people with credit scores from 520 to 580 that are 2-year adjustable loans, meaning that they're going to adjust in 2 years. and then you sell them to a foreign investor and say, hey, this is an American mortgage, probably one of the more secured secured assets on earth because it's an American mortgage, home loan, the American dream. That's not going anywhere. And you sell them overseas and they're buying them up as like a good investment. And then what happens when you start having default rates that are historically ridiculous, and no one's making money on those assets? It creates a global effect. I forgot exactly what it was, but basically the rating for these mortgage-backed securities dropped significantly, led to companies like Bear Stearns and a bunch of other mortgage giants literally closing their doors during this time frame, and that just brought on a greater recession that was outside of just the real estate market. So those, in a jumbled sense, those are the things that happened during the last recession that led to a massive foreclosure market and a real estate bubble, or the real estate bubble bursting and values dropping significantly. Will that happen now? I've been in the industry since that time frame, and what I noticed immediately was that those loans that cater to low credit scores and short-term adjustable rates, they were gone. As well as for a very long time, there were no stated income loans, and there was no loans that didn't require some sort of proof of income or verification of income. Recently, there's been some of those programs opening back up where it's a little bit more flexible, but all those programs are geared toward, or most of them are geared towards high credit scores. They definitely don't have any that are going below, let's say 620 or 640 as a requirement. So you just don't have the same market of low credit scores in combination with short-term fixed rates, and in combination with minimal income documentation anymore. You just don't have that. So unless there's some other thing bubbling within our industry that we don't know about, I don't think that factors within the mortgage industry or within the real estate industry would create some sort of a bubble. Now, if we have a greater recession where companies are laying off for different reasons, then innately that's going to create a scenario where less people are able to buy. The people that are able to buy are probably looking to pay less or able to pay less. And that's where you end up, you can have other factors create a real estate bubble, or a lowering of property values or a decrease in property values. I think that, from what I've seen, I don't really see that happening in the same sense. I don't think we're going to have some massive meltdown of the real estate market. I'm also an optimist, so take what I say with a grain of salt. But the reason why I say that is because I think in areas where, let's say Los Angeles, real estate is still a scarce commodity, right? There's not just available land to build on. And the available places to build on usually require something to be torn down and then rebuilt up, which is going to require permit processes throughout, which creates a delay, which it backs up the supply chain, etc. So you have this scenario where in areas where inventory is low, as long as you don't have some other factor like creating like a real stress on income, you should still see property values remain where they're at or slowly tick up. Obviously when the market's booming, you're going to see property values jumping up, but when things, the market's adjusting, in areas where there's a lot of scarcity, values should maintain, because if there's scarcity, there was probably already a backlog of people looking to buy, right? And most of those people, unless they've had some sort of an income decrease or income issue, most likely those people will still probably look to purchase. Maybe they pay a little bit of a higher interest rate. Maybe they try to offer a little bit less on the property price. But overall, if there's still enough buyers that want to get into the property, and I think in hot areas like Los Angeles, New York, Miami, Chicago, San Francisco, you're going to still see the property values maintain. Maybe some areas, some properties that are a little bit less desirable, there's more wiggle room on their prices. But my perspective is that overall, they should maintain. Keep in mind that if something else crazy happens or we dip further into a long-term recession, then yes, you're going to start to see even those areas have a slower increase and even probably have a decrease. Now, areas where, my mom lives out in the Inland Empire, further out from Los Angeles, where there are still a lot of construction, there is still a lot of construction going on. There's a lot of new development still happening. So in those areas where, there are, she lives in a community that's built by KB Homes, Kaufman and Broad Homes, right? So they've been continually growing in that area. I don't know the numbers enough to say, okay, well, it looks like in my eye, they've maybe built 200 properties in this particular area, and there was a shortage of, 10,000, right? If there's that large of a shortage still, and they're only building a handful compared to the shortage, then I would think that there's still going to be you'll still see properties maintain, right? Because that's still a scarcity. There's still a limited amount available compared to how many people are looking. But I think that in those areas where you can walk up and you could see, 200-300 homes being built, maybe I'm exaggerating, but last time I was out there, I could see at least like 100 to 200 homes being built. Depending on how quickly the builders want to move those properties, yes, you're definitely going to see impact on the purchase price, because with rates going up, or the sell price with rates going up significantly, it definitely slows people from buying. And in an area that's not as densely populated as Los Angeles, or New York, or these other highly populated areas, it's just natural you are going to have a slow for demand. And then when you have a slower demand times the fact that you have a bunch of newly constructed properties and more being built, I would think that you would probably see some softening of that market. Depending on how long the recession goes or how far we go into this, you may see you may see a further softening on those prices. But that's still not the same as what happened in 2007 or 2008, where you have an actual foreclosure market. Leading up to right now, where you have the feds basically pushing rates up to try to slow down inflation, I think that from my memory, employment numbers have been good. Income has actually gone up. We haven't seen some wave of layoffs or foreclosures. So those are the indicators to me that says, okay, look, what they're really trying to do with this kind of like manufactured recession is slow inflation. It's not a scenario where the economy is having issues because people are out of work or because wages are really low. That tells me that, because that's not the issue, that people can still pay their bills currently, even if things are becoming a little bit more expensive. I would hope that the feds made their moves calculated enough to understand, okay, we can tick up rates to slow down inflation without creating a bigger issue like a foreclosure market, without creating a big layoff market. I would think, and I would hope. But without having all the details of all the numbers, my perspective is still based on just my opinion. But check back on this video in a year and let's see what happened. I don't think that we're going to have this big foreclosure market unless this raise in interest rates that is intended to decrease or slow inflation, unless this raise in interest rates creates a trickle effect and creates some sort of bigger recession that leads to like jobs being lost and companies, closing down plants and things like that, which once again, if the Fed's purpose is to create a healthier economy, I don't think that you would do that by sparking something that's going to create a bunch of job loss, right? So I would think that they could see that, hey, this isn't going to create a bunch of job loss. but it will slow spending, it will slow consumer borrowing. And for that reason, I don't think that we're gonna have a foreclosure market. And I don't think that you're gonna see a massive real estate decrease in value. Once again, I think areas that have excess property, you'll see those properties sit a little bit longer. You'll see those properties probably soften in purchase price. But it's all gonna be an ebb and flow. You know, like if you have one house that's selling for, let's say they listed for 560, and you know, you have a few people that want that specific house. If those people still qualify for that 560 number, they're gonna make a choice on if I'm willing to pay that for this particular house, right? So it only takes a few people trying to buy a house to still have that seller be able to get what they want. Now, if you have a scenario where someone's listed their property for 560, they look up and it's been 30 days, they got no offers, then you're more likely to see that property value drop. Or that same person has one offer and that offer's $20,000 less than what they listed it for. That person's gonna have to decide, do I wait longer, see what the market does, see if anyone else comes along, or do I accept the lower purchase price? That's something that also will affect property values and give indications to other sellers of what, as to what their house can sell for. So a bunch of different factors, but at the end of the day, I do think that the changes that were made in the mortgage industry after 2008 shield and protect us from going that deep into some sort of scenario like 2008 where you just have massive foreclosures. That should not happen. And I would think that any softening of the property value is going to be, you know, directed into areas where inventory is really low. Where inventory is really high. I couldn't really see areas in, you know, high demand areas changing too much unless we have like an extended period of recession. Things become darker and dimmer in the overall economy for different reasons. Now, when that happens, then you're gonna see areas in high demand areas, a property that was selling for $2 million last year, all of a sudden the similar property that's up for sale now just has no buyers. And that person's forced to further reduce down to what would be considered a bargain to start to create interest, you know? But I think we're far from that. I think that the fact that incomes have been up for multiple years in a row, that companies are able to make more money because of global opportunities. I just think that like there's more cash out there. I just think that there's more cash out there, and I think that even though inflation is an issue, I don't think that inflation is creating a scenario or I don't think inflation is the same as a scenario where you have people losing jobs and things like that. That's definitely going to turn to a, you know, foreclosure market in most scenarios because people just can't pay their bills. But what we're trying to do right now, at least with what I think the Feds have, you know, what they've said they're trying to do, they're trying to lower inflation, keep costs from continually rising at the rate that it's been rising. So as long as job growth stays and income growth stays, even though things might be tight, even though, you know, you might feel a little bit of crunch because the rates are higher and the ability to borrow is less, and, you know, you're seeing people tighten their belts a little bit, I still don't think that's going to lead into a foreclosure market. So like and subscribe, you know, send me a comment, let me know what you think, let me know if you agree or not. Appreciate you. Hunters of Wealth, streamhomeloan.com. Be back with another video tomorrow. Have an excellent day. Peace.